Hello and welcome to this session. This is Professor Farhat. In this session, we would look at bonds specifically from a very basics perspective. And the reason I say basics because this lecture is designed for a financial accounting course. It's good if you want really basic explanation about bonds, but if you want more details, you can go to my intermediate accounting course where I have a more detailed explanation about bonds. This topic is also covered on the CPA exam for section and on the ACCA exam as well. As always, I would like to remind you to connect with me on LinkedIn if you haven't done so. YouTube is where I house my 1,500 plus accounting, auditing, tax, and finance lectures. This is a list of all the courses that I cover. On my website, I do have additional resources such as PowerPoint slides, true, false, multiple choice, and 2,000 plus CPA questions. So let's talk about long-term liabilities. What are long-term liabilities? Well, when we say long-term in contrast to short-term. And in the prior two sessions, we looked at short-term liabilities. Short-term liabilities are liabilities that are going to be paid within 1 year or the operating cycle. Long-term are obligations that are expected to be paid after 1 year. So they're going to be with us longer than 1 year. How does that fit? Bonds. Bonds are considered a long-term liability, and they are interest-bearing notes payable. What does it mean? Interest-bearing. Interest-bearing means the interest rate is stated. It bears an interest rate, and it's a notes payable. It's a form of a loan. Okay. Now, bonds are sold in $1,000 denomination, usually 1,000 or multiple of 1,000. So if you want to buy one bond, okay, you can say the face value of the bond is 1,000. Now, I said the face value. You're going to see why I said the face value. So if you want to buy two bonds, the face value will equal to 2,000. 3 bonds, so on and so forth. The reason why is because it attracts more investors. To be more specific, they're most likely creditors rather than investors. And what is a bond used for? Basically, you have a company. The company is right here, and the company needs money. Okay, they need money. So one way to obtain money is to borrow money. So they go to the bank, and they want to borrow 100 million. The bank might say, look, that's a lot of money for me. I cannot lend you this money. So what they would do, rather than going to the bank, they can go to different places. They can go to anyone. They can go to individuals with money. They can go to other corporations. They can go to banks as well and financial institution. And what they would do is the company will give these individuals bonds, some form of evidence of lending, and the individual will give the company money. So the company sells bond to raise money because the company needs money. So they sell bonds. Okay. So basically, corporation issue bonds to borrow money. That's the purpose of the bond. Okay. Why don't they go to the bank? Sometimes the bank, they don't want to lend them the money. It's a large amount. Okay. Person who buys the bond is called the bondholder, is investing in the bonds. I like to call them creditors. They're not really investors, but if you want to, yeah, that's fine if they insist on the word investors, but they're really creditors. There are many types of bonds. We're going to look at some of them. Some bonds are secured. So what does it mean? So this is the company. The company sells the bond to the public. The public gives them money, or whoever, to another entity, a person or a corporation. Now, if the bond is secured, it means the company put a collateral. Let's assume that the company is borrowing 100 million. Okay, the company is borrowing 100 million. So they give you the bond, and they would say, if we don't pay back the money, this building is a collateral. Collateral means if we don't pay, you can take that building. So it's basically a mortgage. In a sense, it's a mortgage loan. This is what a secured bond is. Then we have unsecured bond. Guess what? Unsecured bond means what? You have no asset as a collateral. I'm sorry, you're going to give us the money and you're going to trust us. If you don't trust us, don't give us the money because there's no collateral. So those are two types of bonds. Then there is convertible bond. What is convertible? Basically, you will buy a bond. Okay. Then they will tell you you have the option of converting it into stocks. This is a neat picture. It'll be convertible into stocks. So for example, if you have for every one bond, something like for every one bond, you can convert into 10 stocks. Okay, or whatever the ratio is. So the point is, if you like to, you can switch your bonds to stocks. And why would you do so? If the company is doing well, you want to be an owner, so you can switch to be an owner. So this is basically an incentive. They're sweetening the deal. Okay, so this is at the option of the bondholder. So the bondholder convert. Bondholder. Some bonds are callable. Hey, what does callable mean? They're going to give you a call. If the company gives you a call, you have to give them back the bond. So they can buy back the bond. Usually when they buy back the bond, they pay you a premium. What I mean by premium, it means if you bought the bond for $1,000, they might give you $1,050. So they might give you extra money to entice you to buy it back. Actually, they don't have to entice you. It's in the contract that if they call the bond, you have to pay the money. Now you might be saying, why do they call the bond? Why do they ask you to pay back the bond? Is because they don't want to pay interest anymore. Because when the company borrows money, they have to pay you interest. Maybe the company no longer needs that money. They have the money. Therefore, they don't want to pay interest anymore. They will call back the bond. So let's take a look at the procedures of issuing a bond. First thing you need to know, the state laws grant corporation the power to issue bonds. So if you want to issue bond, issue means sell. If you want to sell bonds, you have to go to the state and the state will grant you, just like a corporation. The board and the stockholders must approve bond issues. Not every bond issue, and remember each state is different, but generally speaking, you need to have the approval of the board of directors and sometimes the stockholders to issue bonds, because you need, especially if you're borrowing a large amount. The board of directors must stipulate the number of bonds to be authorized, total face value, and contractual interest. So the board must basically tell, how many bonds are you going to be selling? Are you going to be selling 100, 1,000, 100,000? How many bonds? What's the total face value? Remember, each bond is $1,000. Has a face value of $1,000. I'm going to explain what face value shortly. Don't worry about this. And contractual interest. This is important. Remember, when the company borrows money, they have to pay interest. That's called the contractual interest. It has many other names. Let's assume 6%. So they agree to pay 6%. That's the contractual interest. This is how much they agree to pay for that bond. Okay. Bond indenture. What is a bond indenture? Bond indenture are the terms set forth in the legal document. So basically, when the company sells a bond, they provide you with something called bond indenture. It's basically the details of the contract between you and the bond issuer. Bond certificate, we're going to look at a bond certificate in a moment, and it's going to explain the face value. Typically has a $1,000 face value. So each bond, you can get a certificate for each bond, and each bond has a face value of $1,000. Face value means, think of the money. If you look at a $100, it will have a $100. That's the face value of the $100. It has the $100 printed on it. The face value of a bond is $1,000. So what does the bond really represent when you buy a bond? So when you buy a bond, simply put, when you buy a bond means you are lending money. So what do you get in return? What do you get in return? Well, you're going to get in return the sum of money designated at the maturity date. So you're going to get your money back. Maturity date is when the company pay. Remember, they're borrowing money. If someone is borrowing money, they have to pay it back. They pay it back at the maturity date. The maturity date could be 5 years from now, 10 years from now, 3 years from now, whatever the deal is. That's the maturity date. You're going to receive your money back, plus you're going to be receiving periodic interest payment at the contractual or stated rate on the maturity date. So what's going to happen? Let's assume you lend someone $5,000. Guess what? And let's make it 10,000. You lend the company $10,000. You bought 10 bonds. And you're going to get this money back in 5 years. This is the maturity date, 5 years from now. Also, between now and 5 years, the stated rate is 10%. So every year, they're going to pay you $1,000. So this is the periodic interest payment. So you'll get your money back plus 5 payments of $1,000. Now, bonds usually paid interest semi-annually. If that's the case, you're going to get $500 rather than $1,000, and you're going to get it over 10 periods because 5 years has 2 semi-annual payment. Okay. Issue to obtain large amount of capital. This is why we issue bonds. Okay, investment company sells bond for the issuing company. So what you do is you have an investment company like Goldman Sachs, Merrill Lynch, and those investment bankers, what they do, they sell the bonds. They'll find buyers who are interested in buying the bond. And this is what a bond looks like. This bond is for Spiceman. This bond has a face value of 5,000. Notice here the face value is 5,000. Face value means if this is 5,000, it means this is equal to 5 bonds. What we're looking at is 5 bonds. And the maturity date is May 1st, 2021. The company that's issuing the bond is International Mineral Chemical Company. And 5,000, as I said, here is the par value, 5,000. And this bond is paying 5.75. This is the contractual rate or the stated rate. We're going to see this again in the next session when we talk about bond premium, bond discount. So it's very important to know what a stated rate is. The stated rate is how much International Minerals and Chemical Company Corporation paying for the bondholder. They're willing to pay you 5.75%. Now, bonds are traded just like stocks. So bondholders can sell their bond on a national exchange. Bonds are quoted as a percentage of their face value. Percentage of face. A quoted price of 97, it means the bond is selling at 97 of the face value. If it's less than 100, we say it's traded at a discount. If it's less than 100. Okay, let's take a look at this bond. This is the Time Warner Cable Company bond. 6.5, it means it's paying 6.5%. The maturity date is June 15, 2039. The price at closing, 116.4. Since it's more than 100, this means 116.4%. We say the bond is selling at a premium. Now, why does it sell at a discount? Why it does sell at a premium? We're going to see this in the next session. And yield means if you buy this bond today, you will earn 5.4%. Now, how do you know you'd earn 5.4%? We'll see that later based on your cash versus what you pay today. But don't worry about the yield now. So this is Time Warner Cable, has an outstanding 6.5%, $1,000 bond that matured in 2023. It currently yield 5.49. So if you buy it today, your return is 5.49. Why not 6.5? You earn 6.5 if you bought the bond at 100. You're paying more than 100. You're paying 116.4. Therefore, your return is lower. Okay, at the close of the trading day, the price of this bond is 116.4, or in terms of dollar, $1,164. $1,164. We're gonna talk about determining the market value of a bond. Basically, how much a bond is worth. What's the market value of the bond? Okay. Current market prices, which is the present value, is a function of 3 factors. So when you value a bond, okay, in other words, if you want to find the price of the bond, you value 3 factors. 1, the dollar amount to be received. This is the dollar amount to be received is the face value. For example, in the bond of the International, what's that company? International Minerals and Chemical Company. The face value was 5,000. That's how much you would receive if you have this bond. Length of time until this amount is received. How long? So time. How long? And the market interest rate. And the market interest rate. Now, what do we mean by the market interest rate? The market interest rate is totally different. Totally different than the contractual rate. And what's the contractual rate? Let's go back to the contractual rate. The contractual rate is the 5.75 is what the company is paying. The contractual rate for this bond is 6.75. What's the difference between the market rate and the contractual rate? The market rate is the rate that the investors demand for loaning the funds. That's different, okay? The company might say, the International Chemical Company might say, I'm offering 5.75%. This is the contractual rate, or the stated rate, as a bondholder, or as an investor, I'm going to say, this is not acceptable. I demand 8%. This is my market rate. You want me to buy your bond. I want to earn 8%. So you might be saying, hold on a second. How am I going to pay you 8% if in the contract it says 5.75? Well, guess what? Discount your bond. It means I'm going to pay less than 1,000. If you discount your bond, I might earn 8%. I will do my own math, and if I will earn 8%. We'll talk about this later on. But the point is, we'll see this in the next session. The point is, if the company is offering less than the market rate, less than what the investors are demanding, then their bond will sell at a discount. Now, on the other hand, if the market is only demanding 4%, wow, the 5.7 is a great deal. In this situation, the bond will sell at a premium, and we will revisit this topic in the next session. So let's take a look at an illustration. Assume that a company on January 1st, 2019 issues 109% bond due in 5 years with interest rate payable at year end. Okay, the purchaser of the bond would receive two types of payments here. They would receive $100,000 to be paid at maturity. When is the maturity? 5 years from now. So it's January 1st, 20, 21, 22, 23, and 24. So in year 2024, you would receive back your 100,000, plus you're going to be receiving 5 $9,000 payment. Why 9,000? The face value times the rate. The rate is 9%. We're assuming this bond pays interest annually for simplicity. So simply put, when you buy this bond, you're going to get, this is today, you pay something today, you pay something today, you would receive 9,000, 9,000, 9,000, 9,000, 9,000, plus the amount that, plus the face value, which is 100,000. Okay. Now, how do we find the price of the bond? So I'm going to tell you how we find the price of the bond, but you don't have to worry about it in a sense that for this class, I don't require it. Okay. So how do we find the price of the bond? The current price of the bond is equal to the present value of all future cash payment promised by the bond. So if we say the present value of in 5 years of 100,000 is 64,993, now you'll be saying, what's the present value? Well, we'll say, if I'm receiving $100,000 5 years from now, how much it's worth today? How much should I pay for it today? You'll pay for it 64,993. Once again, for this class, you don't have to worry about this. The present value of the $9,000 payment is $35,007. Simply put, this 100,000 is worth today by itself, this 100,000 on its own, worth today 64,993. Those 5 $9,000 payment combined, they're worth 35,007. Together, they're worth 100,000. Here we are assuming that the market rate and the contractual rate are the same. Again, you don't have to worry about this, but the point is, to find the price of the bond, you have to compute the present value. Let's take a look at this quick exercise as a wrap up. State whether each of the following statement is true or false. Mortgage and sinking fund bonds are both examples of secure bond. Yes, mortgage bond is, as we thought, it's like secured bond. I told you it's a mortgage. And sinking fund bond, we did not talk about. The sinking fund bonds is when the company put money away separately to pay off the bond. So yes, this is true. Unsecured bond are also known as debenture bond. Yes, that's true as well. It's a term you need to be familiar with. Debenture. And don't confuse debenture. Some students confuse debenture with this term, indenture. Give me 1 second here, because I know many students have this problem. Bond indenture. Indenture is the contract. Okay? So don't confuse the two. Easy mistake. Okay? The stated rate is the rate the investors demand for loaning fund. False. The stated rate is the rate that's printed on the bond. That's the contractual rate. The market rate is the rate that the investors demand for loaning funds. So this is false. The face value is the amount of principal the issuing company must pay at maturity. That's exactly what it means. The face value, where you have to pay back whatever is printed on that bond. The market price of the bond equal to its maturity value? No, not at all. The market price of the bond equal to the present value of payments plus the present value of payments of face value. What do I mean by this? Here's what I mean by this picture right here. So I discount, let me erase everything here. So the price of the bond, I'll take all of those payments, discount them. It means I find the present value, take this 100,000, find the present value. Those two together is the market value of the bond, how I find the market value of the bond. Okay. In the next session, we'll actually look at issuing bonds. Once again, if you feel this session was too easy, it's because this is financial accounting. If you want a more difficult or more comprehensive or more challenging topics about bond, go to my intermediate accounting, chapter 13, and you will find what you need to know for the exam. As always, I would like to encourage you to visit my website for additional resources and lectures, and I strongly suggest you subscribe. It's an investment in your career, especially if you're studying for your CPA exam. Good luck and study hard.